Hey, welcome to Everything Money. We're glad you joined us. It's Seth, Paul, and Mo. In this video, we are going to talk about PayPal. Big news yesterday, Paul. PayPal might be buying Pinterest. If you saw that news, we welcome you in. In this video, you're going to learn the fundamentals and the financials behind PayPal to see if the stock is a buy, a sell, or a don't even think about. You will learn from us on how to evaluate stocks, and we will head over to Mo and learn if you want to trade PayPal at a more exciting pace. We will show you how to do that. But first, let me introduce ourselves. This is Everything Money. I bring a normal guy. I bring your questions to a couple fellows who handle over $100 million in real estate, businesses, stocks. They've been investing for 20 years. And so we're going to let them teach you the mindset and the process of investing in a company like PayPal, or maybe avoiding a company like PayPal. I introduce you to Paul, a man who loves farting in his own bathtub. Go ahead, Paul.
All right, so we're at the Everything Money software website. I go to the 8 pillars. I'm going to type in my PayPal right there. Let me make this a smidge bigger for 125 is good. All right, so Seth, PayPal is an exciting company, $292 billion market cap. Now, our first pillar is we want the 5 years of earnings to be under 22.5, 22.5, the 5-year PE. It's at 108 right now, so that's an X. This already screams expensive, okay? Now we also, the next pillar is 5-year return on invested capital. We want over 9%. I'm not surprised, it is over 9%. It is 12.5%. So far, we are seeing a company with 1 X and 1 check. Just to keep in mind, Seth, look at these margins. Their gross margin is 47%. That means every dollar they add in revenue, they generate 47 cents in profit, and to the bottom line, after taxes and all expenses, 20%. Very healthy business. They don't pay a dividend, and their average 5-year free cash flow is almost $4 billion. So this seems like a company that does a pretty good job generating cash. The question we have to ask ourselves is, are we going to pay too much for that cash flow or not? All right, guys, pillar number 3, we go to the income statement. We want to see revenue growth over the last 5 years. So I go to 5 years ago on our software, $11.76 billion in revenue. Today is 23.85. It has doubled. That is a check mark.
Hey, Paul, this is a pretty obvious check mark, but for a lot of new investors, they're investing in these companies where they literally don't even make any money. And we chuckle as if you're buying a business. You obviously want them to be making money at a consistent basis, and growing would be better.
Yeah, so growing their revenue should lead to growth of profit, right? And just because something is growing doesn't mean that the stock is going to go up. The example I always give is Intel and Cisco. In 2000, those stocks were at levels that they haven't seen since then. They're actually selling for lower price today than they were 20 years ago, but their revenues and profits have gone up 3 and 4 times. So obviously, over long periods of time, you have to pay a reasonable multiple of revenue and profit in order to see a gain in stock.
Pillar number 4 is profit growth over the past 5 years.
So again, we go to the income statement. We drag down a little bit, $1.5 billion in net income.
Look at that.
Down to $4.87 billion in net income. That's tripling their profit in the last 5 years. That is a check mark there, okay? Now, one of the most important pillars that's often overlooked is shares outstanding. We want to see a decline in shares outstanding. And the reason, now granted, this company's expensive. I don't necessarily want them buying shares back. However, overall, we don't want them diluting you. When they issue more shares, they're giving you a smaller piece of that pie. If you own 100 shares 10 years ago and the share count has gone up because they keep issuing shares, you now own a smaller and smaller piece. You're getting less of the company of those same 100 shares. So 5 years ago, they had 1.2 billion in shares. Today they have 1.17. So it is a decrease, which isn't necessarily good or bad. It's about how you look at it. Now the company is expensive, so I don't necessarily want them using their cash to buy shares back. But either way, so I'm kind of in between on this one, but it's still a check mark either way.
Pillar number 6 is total long-term liabilities divided by 5-year free cash flow.
So very simply, we want to see less debt on companies. After doing a lot of research, I thought to myself, okay, I look at their average of the 5 years free cash flow. So I go to our main page here on the software. On our Everything Money software, I find the 5-year average free cash flow. I multiply it by 5. That is roughly $19.5 billion. So what I'm then going to do is I'm going to go to the balance sheet. I'm going to scroll all the way to total long-term liabilities, and I want their total long-term liabilities to be less than $19.5 billion. So scroll up to the top. I go to the balance sheet. I scroll to the bottom. Long-term liabilities, 11.64. So that's a check because we wanted under 19.5. And very simply, folks, companies that have less debt are more likely to stay in business and get through the bad times than companies with large debt, right? Very simple.
As we move into pillar number 7, this is our free cash. They will see if they have enough money to buy Pinterest. Paul, they want to buy Pinterest for $45 billion. We'll see if this...
Well, I'm sure they're going to use a lot of debt to buy Pinterest.
I see. And stay tuned for Mo and trading here very soon. Go ahead, Paul. Pillar number 7.
Okay, so what we did here is one of the things that is unique to our software, other software will show you free cash flow in certain areas, but we added it here to the actual cash flow investing section because free cash flow is cash from operations less your capital expenditures. This is actually the money that's left over that they can use to buy back shares, pay dividends, make acquisitions, and pay down debt. This is the truest number versus earnings. So earnings, net income on the income statement, have to do with rules by the SEC and by different accounting laws and IRS laws. So free cash flow is harder to manipulate. That's why I like going to it. So the free cash flow 5 years ago was $2.74 billion, and last year was $4.79. So that's a check mark. Now, one thing to look at, Seth. Look at their last 8-9 years. 790, 1.7, 2.2, 2.7, and they lost.
What happened there?
I don't know, but we can look up here.
Oh, I'm sorry, Paul. They did have an acquisition a few years ago.
Yeah, but that wouldn't affect free cash flow. I'm glad you brought that up.
Right,
Acquisitions is down here after free cash flow.
Okay.
And they had 2 big acquisitions. They had 2 big years of acquisitions in the last 3. But this does not affect free cash flow. You use the free cash flow to make acquisitions.
Yeah, I think they bought a price comparison app called Honey Science Corp last year, $4 billion.
Yeah, 3 point, and then they might have sold off some things. So this is the net amount. So either way, we have a gain in free cash flow.
Everything's looking pretty good, Paul.
Yep, and our 8th and final pillar, we take this average free cash flow. We have found typically over time, you should pay about 15 times free cash flow for a company. But what I want to do is I want to look at their last 5 years. So I pay a higher multiple of that. So what we do is we take this 3.93 and multiply it by 20. That's the market cap that we're going to start at and say, hey, this is about where we should pay for the company. Is it set in stone? Absolutely not. Remember, a faster growing company you should pay a higher multiple for, but we want to have some sort of starting point, and we always pick 20. Our pillar is based on 20. So 3.9 times 20 is $78 billion. The company is a $290 billion, whatever it is, company. That's an X.
Oh boy. Way off.
So we're going to go up here to the 8 pillars tab. That's exclusive on our software. It'll actually show this to you. Now look at that cycle, Seth.
Yeah, we like this.
Mo, what do we think about this one? Whenever we see this, what do we think?
It looks like there's overvaluation.
That's it. Whenever we see, this is a very common trait for companies that we like that are just overpriced. They have 6 check marks and 2 X's, and the 2 X's are on PE and free cash flow. So what this means to me is, this is a company I like that I just want to pay attention to. Now, next we're going to use the stock analyzer tool. Now, as I said, guys, this is a very standard form we use for companies, whether the company is not growing or growing 40% a year. But we obviously can't assign the same valuation metrics to a company that's not growing versus one that's growing 40% a year, right? We have to apply different metrics. That's why we created the stock analyzer tool as part of our software. So I go in here, very simply, I pick an analysis number of years. I might pick 10 years. PayPal, I don't think PayPal is going around. We've been using PayPal for a long time, haven't we? They have Venmo now.
They were the original online payment people that became big.
Actually, Elon Musk was a founder of PayPal.
Yep.
Yesterday, I needed cash. I don't have a debit card. Mo has a debit card. We went to an ATM. He took out cash. I Venmoed him the money. Simple. Easy peasy, lemon squeezy. These are the things. When I have to pay my landscape guy, he just sends me a request on Venmo, right through PayPal. Whenever I see anything on a website to buy, I click the PayPal button because it's just so easy. They have all my information. They have my address. What was that stuff?
I love it too, yeah.
It's the best. So anyhow, so then you can pick either 1, 2, or 3 assumptions. For this, since PayPal's been around for a while, I'm only going to pick 2 assumption levels. Now, here's what it does, guys. We have our historical 1, 5, and 10-year numbers on revenue growth, share change, profit margin, free cash flow margin, PE, price of free cash flow, and then what desired return I want. So I'm going to go in here and say, okay, in the last 5 years, they've grown at 19.3% a year in revenue. I'm going to be conservative and call it 10 and 15% for a low and high. Because remember, I still want to be conservative. A good value investor will be conservative, find companies that are selling under the conservative values. Share change. In the last 5 years, they bought back shares, but I'm going to be conservative and say they don't buy back shares and they buy back negative 0.5%. Profit margin, I'm going to go with 12 and 16%. Free cash flow margin, 20 and 22. PE. Now this is the hard one, guys. Uncle Mo, what do you think of this PE of 60 and free cash flow of 61?
A little rich.
Now, people would tell me, like, now this is a faster growing company. 10 and 15% revenue growth in the next 10 years is pretty fast. But remember, guys, what PE will you sign it in 10 years? It will be a bigger company in 10 years. A bigger company, my argument would be lower PE. Why? Less growth. You should pay out higher PE for more growth, but we're looking at what we price the company out 10 years from now.
I'd probably go 14, 16.
That's exactly what I was going to do.
15, 17, yeah.
I was going to do 14, 16. Now, I always pick 12.5% desired return. Why is that? Well, because I'm a value investor. I don't want just the market return of 10%. If I just want market return, what would I do, Seth?
Put it in SPY, VOO, and just let it run.
Yeah, but if I'm going to pick individual stocks, I want to pick individual stocks that I'm going to get a 12% or more return on. So very simply, I hit it all, hit the analyze button. The stock is currently 248.
Oh boy.
And guess what? The overvaluation hits. Even at 10 and 15% revenue growth, I have a low price of between 50 and 80, and a high price of between 100 and 146. So my gut tells me I need to pay about $100 for this stock.
Yeah, so if you overpay today, you could never get to a 12% return using our calculations.
Correct. So let's do that. What return would you get? I'm going to guesstimate here. Let's go 5% return. It's only one of the numbers makes it worth it today. Only one of the values. For us to get the half of it value, the in-between value, still not there. At 3% return, we still have only one value that works. This is what's so great about our stock analyzer tool. You can actually see, so if you believe these assumptions above, and you buy the stock today, at only one situation do you make over a 3% return over the next 10 years. That's the point of all of this. That's the point of finding a process.
Yeah.
So, this software is available to everybody. We created this because our users saw us doing this process and said, hey, instead of us waiting for your videos, how do we get it? We made the software. The great news is this software is all in a mobile app. You get a community of over 6,000 people who are talking about the software. So if you feel alone, you have nobody to talk to about investing, 6,000 people waiting to talk to you. You have exclusive daily content that we release that are only for us, that are only on the website, the app, and our community. You have a real estate analyzer tool, and all these other things that are coming to the software right here on the right side. All of these things are coming. This is all for 90 cents per day. That's it. Less than a cup of coffee. If you're serious about your financial future, click the link below on Patreon or everythingmoney.com. Go sign up. It's 90 cents a day. No brainer. This will make you 100 times over your money if you just follow the right process and just make 1 or 2% more per year.
Mo, are you excited about PayPal possibly buying Pinterest? Or do acquisitions like that help companies?
You know, it helps. It can help and it hurt. It depends on the situation. We've seen companies that go out there. I use AT&T for an example. They make acquisitions way beyond what they should be doing, and they get put in tough situations. Maybe this is a good situation for them to acquire Pinterest. I don't know. To me, I don't get the connection between the two.
I don't either.
But
Paul,
it's fine. And
where would they come up with the money? You said they'd take on debt. Are we talking selling off some shares?
So I have heard that it's shares.
Shares?
Yeah. They're going to be diluting.
Is that a good move, Paul, if I'm a PayPal holder?
So you got to look at acquisitions and say, they're investing capital that I have a part of. If they can get above average return on their money, above a 10% return, I'm okay with that. History has shown that acquisitions tend to be, it tends to show investors were being serious, but overall they tend to not do great. They tend to be value destroyers for investors. Mm-hmm. We've looked at Pinterest before. Go look at our past videos. We've looked at Pinterest. It's a little pricey.
And not only that is, I mean, Pinterest, their current market cap right now is $40 billion, and the acquisitions for $45 billion.
Yeah,
so
I heard 48
you're
on mine.
looking at going overpriced on an already overpriced company.
I see, Mo.
You know what I'm saying?
Well, I just emailed the CEO of PayPal. We'll see if he gets back to us, Paul. He very well might.
Did you?
So, I did.
Did you copy Elon Musk?
Listen, I might as well try, Mo. Mo, are people trading this in the bid-ask? If you're looking to trade this, not a long-term 10-year play, if you want to trade this on a daily or weekly basis, Mo can assist you in the Bid-ask Nation. Go ahead, Mo. What do you got?
So apparently, people on Wall Street don't like this because in the past couple days, we have had major drop. Yesterday, they were down 5%. Today, they're down another 3.5%. So that usually the company that's doing the acquisition, they get hit in stock price, and the company that's being acquired gets the bump in stock price. So right now, as you can see, if we just go back to February, this was their all-time high right here. They tried to touch it again, and now they've dipped below their 200-day moving average, and they're just struggling and consolidating in this area. So right now, from a short-term perspective, this is a tough one, because if you try to go short on this, you could get bottomed out right here by this resistance line that is very strong and has been sitting there since May of this year. So what I would rather do is go at it from a long-term perspective. I would look at this thing and say, it does have some room to run, but the first thing I want it to do is bottom out here on its stochastic and then make its climb back up through the sweet spot. That is exactly what I would want to see, just because I see a lot more potential coming this way than going this way because of that strong resistance point that I drew for you. So for $1.30 more per day, you can jump in, get all the exclusive content, all of my teaching content, my classes, my seminars, and come and trade with me. Make a ton of money.
Final take on PayPal, Paul.
I'm just holding off to it. I will add it to my watch list. I will make sure I pay attention to it, and the stock falls in a downturn, I'll probably be an acquirer.
Learn from us, Fire Financial Planner. Use our software to get a hold of your finances. Fondle the thumbs up. We'll see you next video.